I think the results over next few quarters should be very interesting. I think the earnings momentum should now shift towards corporate banks, both in the public and the private sector. Metals sector should do very well in terms of numbers, and I think even engineering and the construction space should start recovering. And the earnings growth, I think, may be below expectations in the consumer and the pharma space.
The kind of news flow we are picking up in the corporate sector, where corporate India is looking at deleveraging the balance sheet, whether it is the Ruyas or the Ambanis and to some extent Jayaprakash Associates. Do you think now we could see a big turn in wholesale banks because the bad loans will become good loans and recovery will start?
I think that's quite logical to expect, and this is what we had always said, that the corporate lending in India is secured lending, and the value of the assets that have been created is not going down in a growing economy. Therefore, these corporates were very cash poor but very asset rich, and so the loss ratios in such lending is not very high. I mean, the loans become NPAs on a classification basis for some period, but over time they tend to be upgraded. And I think this is what will happen. For example, in the SR group, with this transaction behind us, I think the debt equity, the debt ability to service debt for the entire group has improved dramatically. So any loans which have become NPAs over time, there is a very good chance that they will be upgraded.
I guess you were the first one to talk about that Indian pharma could see a structural disruption. 2013 it looked unreal because numbers were so rosy. But now reality is haunting them, whether it is pricing or it is the currency tailwind which is missing. So do you think the problem in pharma, which by the way is one of the underweight sectors that is paying off now, is that real? Is that pain here to stay?
So I think at a broader level, yes, I think it is here to stay because the market share of Indian generic companies in US has become pretty sizable. And on that base, it is very hard to deliver meaningful growth because the US generics market itself is not growing. But there could be individual companies which may do something different, something innovative that they could grow. But I think at a broader level, I think growth will be challenged. And the second factor which drove earnings in this sector for last few years was the sharp depreciation in currency. With current account deficit at nearly zero, with very healthy FII and FDI inflows, I think currency should be stable in the foreseeable future. So the tailwind of currency depreciation is also not available to this sector.
Now interest rates are coming down in India. That is the big story. Savers will not get affected because inflation also structurally is down. So who will benefit?
So the borrowers will benefit. The companies, the leveraged companies will benefit. Those who are paying the interest expenditure, they will benefit. And even the banks will benefit because the NIM of banks is relatively stable in different interest rate regimes. But the treasury gains of the banks will be very significant. In our assessment, every 1% fall in 10-year yields creates a on-the-book gain of more than 1 lakh crores for the entire banking system.
So your view on wholesale banks looks like it's only getting solidified. I mean, 2013-14, when we interacted on various forums, including me, we raised concerns about, are you buying a space where market share losses were real? But now with the way economy is turning, looks like the leadership in the market is changing.
So I mean, the bigger public banks have not lost market share. And I think people talk not in specific terms but in general terms that there are market share losses. But bigger public banks actually have not lost share. And I think corporate bank is a more appropriate word than wholesale bank because all these banks have a great underlying deposit franchise. In fact, they have some of the best deposit franchise, the lowest cost of funds. And therefore they are retail banks when it comes to raising deposits, and they have lent these to corporates. So that part you can say in a way is wholesale. But the stress is coming down. I think with every passing year, now we should see the ROEs of these banks improving. And in my assessment, by fiscal 19, by 18-19, we should see fairly normalized levels of profitability for this space.
The way your portfolio is positioned looks like you are making a case that the market leadership is either has changed or will change dramatically because you don't own too many expensive consumer names, hardly any exposure to consumer staples barring your PNG here or there. but you're completely betting on what could be called as the India-specific domestic growth portfolio.
So I think yes, if you look at next 3-5 years, it is going to be quite different from the last 5 years. Currency, interest rates, inflation. I think capex is slowly recovering. Inflation should be low, currency should be stable. So I think this leadership in the markets is changing or should change in my opinion. If you look at
Now,
the next
IT is still growing. Markets think that IT is not going to grow, but these are extraordinary and tough circumstances, and 8 to 9% growth is there. Do you think it's a matter of time that markets will recognize that between IT and pharma, go for IT, not pharma?
So I don't know, that's my view that IT is probably better than pharma, but it's an assessment, one could be wrong. But I think IT still represents reasonable growth, and the multiples in IT are a lot less than multiples in some of the other sectors.
It's heartening to see that now mutual funds are SIP culture has started, and average Indian is saving 2,000 rupees, 5,000 rupees a month. So do you think the trend in the SIP culture, is that a trend which is here to stay?
I think so, and I think the credit for this goes to lots of people. The distributors, the IFAs, the banks, the media, people like you. I think mutual funds, the regulator, everyone has played their part, and no one asked for the full form of SIP, which is a great achievement. So I think equities, I think we should see very significant flows from retail, Indian retail investors into equities.
But in general, do you think return expectations should be low now because earnings haven't started, markets have run up? And your equity return is always a function of again, your cost of borrowing or risk-free capital. The risk-free capital now is not 9%, it is at sub 7% now.
I think when we say markets have run up, it is true for last 1 year. But if you look at last 8 years, markets have done nothing. So I think markets have lagged economic growth for fairly long periods of time. The market cap to GDP of India is sitting nearly at 10-year lows. It is true that the profit growth has been weak for last 2 years, but I think that is all set to change. In next 2-3 years, we should see fairly robust earnings growth.
There was a lovely note which had hit my mailbox, and I am proud to say that I am a unit holder of some of the schemes, was that Indians should not save in gold, they should put that money in equity. So if you have to really make a mega asset allocation call right now, because I think before we get into sectors and stocks, it is important to check the asset allocation. What would be that mega trend for next 3 years, next 5 years?
So this is what we have always been saying, that gold delivers returns which is close to inflation, and equities deliver returns which are significantly more than inflation. And returns of both gold and equities are volatile, they are not fixed. So I think it makes a lot of sense that what you are investing in gold, at least a reasonable part, a large part of it, if you could invest in equities, you have a similar time horizon, both give you volatile returns, but over longer periods, equities give you meaningfully higher returns compared to gold. So I think there is a lot of sense in making that switch, at least on a part of your gold savings.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.